that most of the liquidity actually came earlier because of COVID. But generally speaking, the liquidity cycle is this year. So we're expecting an expansion of liquidity.
According to Raoul Pal, we're entering what he calls the autumnal season of the financial cycle. Basically, a mature phase where massive amounts of debt are due. In fact, over 10 trillion worth of debt needs to be rolled over this year. And to do that, the system needs a huge injection of liquidity. Now, liquidity is just the amount of money flowing through the financial system. And when liquidity rises, risk assets like crypto tend to benefit. Raoul Pal points out that during COVID, we saw an early wave of liquidity that fueled a massive bull market in crypto. He believes we're setting up for a similar expansion in 2025. Not driven by a pandemic this time, but by the need to refinance debt. To track this, he watches things like global liquidity and the money supply, including cash and deposits across economies. These tend to move faster than official liquidity indicators and is strongly influenced by the US dollar, government spending, and private sector. So what does this mean for Bitcoin and crypto? If liquidity expands like Raoul Pal expects, crypto could see strong upward momentum in 2025. But if liquidity tightens due to policy changes or unexpected shocks, we could see downside volatility instead. The bottom line is that Raoul Pal believes that the liquidity cycle is turning, and that could be one of the most powerful forces behind the next big crypto move.
These are global numbers. Everyone gets confused. The Fed are going to cut rates. It's irrelevant. It's irrelevant. It's this global liquidity that pays the global debts. Don't forget, 50% of the entire world's debts are in US dollars. That's one of the things that Scott Bessent has been talking about. Steve Merrin's ideas are about, is trying to reduce that. Good luck to that, but that's what it is, and it's the global cycle. So we know that the dollar is weakening. We'll talk about that later. That's a big part of this. We know that interest rates are coming lower, which is part of global liquidity and also part of financial conditions. We know that the US has been using a drawdown in the reverse repo and the Treasury general account. It will rebuild because of tax season coming now, but generally the US is injecting liquidity. It will not use the balance sheet yet, but it may well do later in the cycle. We need to see. But where the big game is to be played is China. China's balance sheet lags China bond yields. So if you remember, the US said, well, we won't ever get to QE until our bond yields get close to zero. Well, that's happening in China right now. They're in a full debt deflation. And China's going to be very important to this story. And it's the most important headline that is going to come is what the agreement is with China. So the agreement with China will be, and I've been talking about this for a year in Global Macro Investor and Real Vision Pro Macro. The agreement with China will be, you will agree to tariff terms. We will battle it out in public and make us look like we're all strongmen. You will agree terms because you have a dollar debt problem. The Chinese have a dollar debt problem and they need to service those debts. The problem is the RMB is too weak and the dollar is too strong. They don't have the cash flows in a slow economic environment to pay for it. They know, the US knows. Yellen even went to talk to them about it when she was still at the Treasury. They need a weaker dollar. Now, the mechanism by which China gets access to those dollars is usually via the euro-dollar market, and it's Japan that is the big driver of the euro-dollar market. So when we look at the weakening of the dollar, I like to focus on dollar-yen to think of how this plays out. The yen is one of the world's big exporting economies, and it has a very weak currency. The yen needs to strengthen, and a strengthening yen and a weakening dollar will allow capital to flow into China and other dollar borrowers via the euro-dollar market. And the key thing that happens here is this chart of the Chinese currency against the yen. The Chinese currency was too strong versus the yen, and that has been putting pressure on Chinese exporters and the Chinese economy. it needs to rebalance lower. And this head and shoulders top and this head and shoulders top tell us the US, Scott Bessent, is going to get what he wants, which is a weaker dollar. A weaker dollar will stimulate global demand. It stimulates and allows for the rolling of global US dollar debts. It allows for exports and imports to free up. It allows for the movement of trade, even with tariffs. It's a very big deal, the dollar weakening. And if China can have a weakening yuan, a strengthening yuan, a weakening yuan against the yen, what it allows them to do is to compete. And that rebalances global trade and gets the global growth cycle going. So China headline risk to the positive side is the big one. Everything else is kind of noise, because this is the big rebalancing that the world kind of wants. Everyone has a trade-off here, and everybody will come to the table for a trade-off, even China. But of course, everybody needs to look like a tough guy in negotiations, but something will happen and we will rebalance and we can move forward. This is exactly what happened last time when Trump was in power in 2017. What we had was called the Shanghai Accord. It was a kind of public, not public agreement to weaken the dollar, to allow the Chinese to stimulate, because they need a weaker dollar to stimulate, because they don't want to weaken their currency via the currency band, because if not, you get a devaluation, which they do not want. So that was the Shanghai Accord then. The dollar fell dramatically and the Chinese stimulated massively. If you remember 2017, the Fed were raising rates. They were shrinking the balance sheet, but China and Europe stimulated. And that was via this mechanism. So this time around, we've got the Mar-a-Lago Accord, which is some generalized understanding that an agreement has happened.